Welcome to another edition of the Nation Leadership Forum. As always, this is the platform that creates an interface between policymakers, private sector stakeholders, and you and I, who are the general public, to discuss matters of policy concerns and see how we can influence the policy action in this country and hopefully move forward the agenda of economic growth and development. Tonight, we are focusing on the subject of the pensions industry. And remember, you can be part of this conversation by tweeting at NTV Kenya, at AmbokoJH. The hashtag is NMG Leadership Forum. Kenya's pensions industry has at least 1.2 trillion shillings in assets under management, making it a key player in the country's formal financial services architecture. This size notwithstanding, only 20% of workers are enrolled in a pension scheme, with majority left without a steady income upon retirement. In the recent past, there have been a number of reforms within the pension sector, including through the Nssf Act of 2013 and more recently, the Tax Laws Amendment Act of 2020. How can we widen inclusion in the pension services and cover the informal segment of the economy adequately? What do some of the proposed changes in Kenya's pensions regulatory framework mean for the sector? And finally, and critical to unpack all this, I'm joined more by the Chief Executive Officer of the Retirement Benefits Authority, Mr. Nzomo Mutuku, the Pensions Manager at CIC Life Assurance, that is Madam Jane Gitao, who is also a council member at the Association of the Retirement Benefit Schemes. And also joining us is Mr. Sandeep Raishura, who is the Chief Executive Officer at Zamara. And finally, I'm also joined by Mr. Hosea Kili, who serves as the Group Managing Director and CEO at CPF Financial Services. Let's get started, and I just want to focus on the issues of the regulator, and that is Mr. Nzomo Mutuku. Let's begin by unpacking this discussion that in a 1.2 trillion shillings industry, only 20% of workers are formally covered. Why is this the situation, and what are we doing to try and widen the inclusion?
Thank you, and good evening, and thank you for having me on the show, and good evening to my fellow panelists. It's good to see you, stakeholders from my industry. Let me start with the good news. The good news is that our assets is now 1.3 trillion, not 1.2, and our coverage is up to 22% of the labor force. So we have moved from 20% we had the previous year to 22% currently. And if you compare this with most African countries, this is actually quite impressive, because a lot of countries in Africa, they're even below 10% or 12% and thereabouts. So that is the good news, that we have been able to increase coverage over time, and it is quite high compared to our peer countries. But obviously, as you say, 22%, 20% is still way too low, because it means 78% of the labor force are not in pension arrangements. And what is worrying about this is that Kenya is considered to be the global leader in terms of using digital technology to drive financial inclusion. If you look at the financial inclusion figures for Kenya, we have come from a very low base to over 80% in terms of people captured within the formal financial sector. So it seems other sectors like banking and so on have moved ahead and been able to bring many people on board, but in the pension space, we have not been able to leverage really on this technology to bring people on board.
I see.
So what are we doing? Very quickly, a couple of things that we have been doing, and that is why we have seen this increase that we have seen. Number one, of course, is launching new products which leverage on digital technology. And if you look at some of my fellow panelists, they'll tell you about the products they have launched. Zamara has launched a product, CPF has launched a product, and Nssf that you mentioned has launched a product. And these products have been able to bring on board a number of Kenyans, particularly those in the informal sector. And number two, as RBA, we have been doing a lot of education campaigns. We have been going down, to the people in the markets and talking about why they should save for retirement. So we have made some progress, but a lot of work to be done.
Great, and that's a good point to raise, because we're now at 1.3 trillion shillings, you say, and 22% coverage. Let me move on to Sandeep. Sandeep, we seem to see a lot of sensitization out here regarding insurance, but not so much regarding pensions. What's the challenge in terms of packaging this product? Because this is a very critical element when it comes to the financial planning of any given household. Sandeep, it seems that I have a challenge in terms of getting your audio, but maybe let me cross over to Jane Gitau, who is a key player in this industry. Jane, in terms of widening inclusion, what's the gap that we are facing by way of sensitization, especially among the youthful population in this country?
Okay, thank you, Julian, for the question, and thank you for the opportunity for this session. Maybe in terms of the challenges, before we go to the challenges, I think maybe we can look at what statistics are we talking about and what are we targeting. And this is so much with reference to the Kenya National Bureau of Standards, the census of 2019, where we are given certain age cohorts, like 18 to 25, we have about 18.9%. 26 to 35, we have 26.2%. And 36 to 45, we have about 18.3%. So in terms of potential, that is already a potential in the informal sector, because we realize that that is the sector that is employing about 80% of the workforce in the country. What I would say is the challenge is that in terms of, we have not optimized the capacity in terms of the digital and the mobile coverage. If we could move faster, like maybe the other financial services sector, in terms of application of that, would be able to widen the inclusion or the coverage. The other area that I would think maybe we are falling short of is in terms of having the policies in place, which have spelled out how this needs to be captured. I know there are very key critical policy enablers that we have in our country, such as the Nssf Act 2013, and the National Retirement Benefit Policy. Those two instruments are very, very important for implementation. Okay. And they spell out the structure so well that each of these sectors are fully covered. But without implementation or at least deployment of the tools, I think that becomes a handicap to do that. Okay. And very interesting is that the target population that we have are already very optimistic about maintaining their lifestyle in retirement. So the challenge is they do not know how and how much they need. Okay. So they are looking upon us as the leadership to guide them on how they can go about the journey. So I think if we could think about how we, again, design a product or a scheme that is totally geared towards the saving for this particular population, yes, we would be able to move on.
Let me hold you at that, Jane, and cross over to Hosea. We'll be coming back to a lot of those policy documents you have mentioned, including the Nssf Act of 2013. But Hosea, Jane there says we have not optimized the digital capacity as far as sensitization on pensions is concerned. What more can be done in this regard, Hosea?
Thank you so much, Mr. Mbogo. And thank you, my fellow panelists. There is a lot for us to do to realize this objective of widening the coverage. You must understand that to Kenyan, retirement is far away. In most times, they don't expect to begin saving early. They think it's an issue to be done when they are about to retire, and that is too late. For the youngsters, the idea of saving for retirement competes too much with their current needs. They need to have a good time, they need to go to school, they need to have fun, they need to buy things, and they need pocket money. There's no way they can be attracted to save for retirement. I advance one view that the 1.3 trillion industry we have is only because of good employers. Good employers who have set up schemes for their employees and actually enforce savings by the employees and supported them by making matching contributions. Now, that is what has made the industry where we have reached now. What, therefore, I have observed is that Kenyans, to some extent, require some element of compulsion for them to be able to save and to think that this is an important thing to do. Because we see at retirement, when people are 60, they begin to look upon the government for sustenance, and it's too late. So since the government is the final sustainer of all citizens, it behoves the government under our 2010 Constitution on the responsibility on Social Security to actually enforce saving. And that is the solution I propose for us to increase savings to at least more than 70% in this country. The other one is to propose, Samboko, that we create a structure whereby, just like the way we do encourage fish to come into our traps, we must provide people with certain bundle of benefits to go along with pension, so that they don't look at pension as this thing I don't have to do now, and they don't have to sacrifice their normal things like saving for health, saving for insurance, life insurance, or saving for education.
Okay.
If we can put all those things together,
yes.
And the model I therefore advance, Mr. Mbogo, is the CPF or Central Provident Fund of Singapore model. That is the model I really want to propose for us as Kenya. Good.
Some good introductory remarks there. Let me cross over to the regulator, that is Mr. Nzomo Mutuku. The mention of the Nssf Act 2013 has definitely emerged, and we know that this has been, the implementation has been stifled by a lot of challenges in the court. And Hosea did mention that the 1.3 trillion shillings asset base we talk about is because of the benefit of employers. Now, in the Nssf Act, if you look at Section 20, there was a proposal of bumping up the remittances, the statutory deduction that are normally made, to about 6% of the employees' pensionable income, being matched again by 6% of the employer. How much has this challenge now derailed the industry from optimizing its potential, Nzomo?
Yes, thank you. If you look at our industry, we have 4 components. We have Nssf, we have occupational schemes which are started by employers, as Hosea said, good employers who voluntarily start those schemes. We have what we call umbrella schemes, which bring together many employers. And we have the individual pension plans, which are open to anybody to join. And that's what we have been using to drive this coverage, particularly in the informal sector, because they are not employer related. Now, out of these 4, the one which is compulsory is Nssf. But it is the one which has the very lowest contribution rates. And if you look at the membership, it's the one which has the most membership. So many Kenyans are in Nssf, but they are not in other schemes. They're not in occupational schemes, individual schemes, umbrella schemes, and so on, which means they are really contributing the bare minimum because of the low contribution rates to Nssf. So for this category of Kenyans, you know, the amendment was good because it was going to enable them to contribute more so that they would be able to get more benefits when they retire. And you know, the Nssf Act allowed for opting out for those who have the other schemes. So those who are in the occupational schemes and so on would opt out from the high contributions to Nssf and make their contributions through the other schemes. So it was really helping those who are having the minimum contributions to save more for retirement. And of course, they could also opt out. Okay. So I think it's unfortunate that the Act has not taken off since 2013. You know, those several years. And we would hope that the ongoing discussions trying to unlock that Act will be fruitful so that it can be implemented.
Jane, just to get your thoughts around the same subject, the Nssf Act since 2013 up till now hasn't taken off, as the regulator rightly points out. How much of a drawback has this been to the industry in your view?
Julian, maybe come back again. I think I have missed you.
Yeah, my question, Jane, is the Nssf Act has not taken off since 2013, and clearly the regulator does indicate that this has been a major drawback. What is your assessment of the impact this has had in terms of growing our pensions industry?
It has actually had a very big impact in terms of growth, because I think the anticipated growth would have been so huge. You can imagine the gap between from 200 of value of contribution to about 12% of the national average earnings. So it is quite a big impact over a period of 7 years. So you can imagine how many citizens have lost the opportunity of saving, because it was, being an act, it was meant that it would compel every employee to be able to up the contribution rate.
Okay, and I'm told we now have Sandeep Raishura from Zamara. Sandeep, welcome on set if you can hear me now. We're discussing the issue of the Nssf Act of 2013, whose implementation has been derailed since 2013 by way of legal action which has been taken at the courts. How do you think this has impacted the industry, Sandeep?
Look, Julian, I'm sorry we've been having an IT glitch, but I hope you can hear me well now.
Perfect.
And I'm on record as saying that the Nssf Act of 2013 was in our national interest as a country. This is a piece of legislation that was designed to address some of the key weaknesses in the pensions industry in Kenya. Mr. Mutuku talked about the low coverage. Yes, we are at about 20%, but that's still very low. And again, the other thing to mention is the very poor adequacy of benefits. And I think we need to discuss this. But the Nssf Act was designed to meet those two twin challenges. It would have compelled every Kenyan to save. And as Mr. Kili said, we need to have a compulsory pension system in Kenya. So the Nssf Act of 2013 would have introduced mandatory contributions, and it would have introduced mandatory contributions at a sensible level, i.e. the 6% that you talked about. And also those contributions were going to be phased in over a period of 5 years. Importantly, the Act also provided that the benefits would be paid in the form of a regular income, a pension, rather than a lump sum, and also provided that future contributions would be preserved and could not be accessed until retirement age. Again, the Act introduced a very healthy level of competition between the private and the public sector for the second tier of contributions. So all in all, this Act would have achieved the objective of improving the retirement security of Kenyans, and secondly, would have significantly increased the pool of savings in our country. The 1.2 trillion that Mr. Mutuku talked about,
yes,
had the Nssf Act been implemented in 2013, the total asset base now would have been at least 1 trillion shillings higher. We would not have needed to go with a begging ball to any country to support us, even at this COVID-19 time, right? So I really hope that stakeholders can come together, the government can take the leadership, and that we can collaborate and have this act, this piece of legislation implemented, because it is good for our country.
Right, good thoughts there, Sandeep. Just before we take a break, Hosea, very briefly, your thoughts on the Nssf Act of 2013 and what impact this would have had on the industry.
Thank you so much, Mzamboko. I am actually the current chairman of Association of Pension Trustees and Administrators, and we have of the view that that would have been a very wonderful piece of legislation because it brings in the issue of compulsion for every citizen and every employer. The only problem which the industry has been talking about and which has actually created issues is the double contribution element, whereby an employer, like in my scheme, CPF, has already is contributing 15%, and they will be required to also contribute an additional amount to go to Nssf. And then an employee also in my scheme and many other schemes which are already set up in the country are already contributing higher rates, and they are going to be required to contribute another amount to go to Nssf. Now, the area of compromise would have been for those schemes which are already contributing more than the minimum required to go to Nssf, they would be allowed a total opt-out and maintain their members in one scheme,
yes,
so long as the same rules which apply to Nssf members are applied to those schemes where they are comfortable. The idea of having two separate funds for the same person is what our members in the industry have not been happy about.
Okay.
We are ready to have a negotiation on this issue, and we believe Nssf management and the leadership of this country through the Ministry of Labor should actually engage the industry, and we can resolve these issues.
All right, thank you very much, Hosea. And that point by Hosea takes us to our first break. Remember, we are discussing the issue of the pension industry in Kenya and how we can widen coverage. We'll be right back with a lot more after this short break. pensions industry and how we can widen coverage to include majority who are in the informal sector. Remember, at least 80% of Kenya's labor force is in the informal economy. And just to pick up the conversation from where we left, Nzomo from the RBA, we've been discussing the issue of the Nssf Act, but to be honest, if you put that conversation out here, many will challenge you and tell you that one, there's the challenge of appropriation or misappropriation of funds as far as the Nssf is concerned, and this is the key concern when it comes to the issue of being asked to contribute more. Don't you think this is a valid concern, Nzomo?
A major concern. But today, Nssf is regulated by RBA, and it follows the same rules that all the other schemes that we have talked about, the 1,258 schemes that we regulate, follow. So, for example, they have an annual general meeting where members can come and ask questions. They are required to publish their accounts in the newspapers. They have to comply with the investment guidelines that we have set. So, for example, when we came, Nssf had something like 70% of its assets in real estate, but now they are below 30% because our guidelines give a maximum of 30%. So, of course, we know all the historical issues which have been there, but now Nssf has, over time, become a gradual, a well-regulated scheme, and members can put their money there with confidence.
And just to stay with you before I cross over to Jane Nzomo, one other issue which is emerging regarding the Nssf and why many might not be incentivized to remit to it is the issue of the rate at which, or the delay in disbursements of pensions. What's being done about this?
I think, again, that is more of historical. Nowadays, Nssf has also adopted technology. You can use your phone to get your statements and get your balances and so on. They have standards that we have insisted on in terms of how quickly benefits are paid. For all schemes, benefits must be paid within 30 days of somebody retiring or the benefit being due. So they're also bound by these standards. And remember, RBA is here as a regulator, and one of our mandates is to protect the interest of consumers. So any consumer who has an issue with Nssf or any other scheme, they should come to us because that is our role, and we can assist them with their issues.
Jane, in terms of what more could be done by way of streamlining the Nssf, which definitely is one of the key entities in this space, what do you think should be done? Because this is definitely a key player in this industry.
Okay, maybe what I think can be done to be able to up the confidence of the contributors about the whole scheme, because I think all employees, we are members of that, is continuous engagement with the members, voluntarily sending us statements without having to prompt them. That is the only point that we can feel we are connected with them. And then now that will be able to lift the trust in terms of transparency and constant communication with the members.
All right, and crossing over to Sandeep, definitely, Sandeep, you have some strong views in terms of how the Nssf and the pensions industry, by and large, can be streamlined. Just share with us your thoughts, Sandeep.
Okay, Julian, before I do that, I just want to comment on a couple of things, right? So first and foremost, to add to what Mr. Mutuku said, the other thing to add is that in addition to all the other reforms that have taken place, 70% of the assets of Nssf are now managed.
Sorry about that. We seem to have lost the audio from Sandeep yet again. Crossing over to Hosea. Hosea, just quickly your thoughts regarding the streamlining of the National Social Security Fund.
Yeah, Mr. Mbogo, thank you. The Nssf is actually, the way it is crafted in Kenya, is actually an umbrella occupational scheme, because it's only for employers and employees or who are compelled to contribute to Nssf, and there is a defined contribution system. Normal social security funds are defined benefit schemes in other countries so that they qualify to be, and there's an element of government contribution. What needs to be for streamlining to gain more confidence, just to assist, to add to what Jen has said, is actually to look at governance. Governance is a very important part of improving confidence. I think there's a need to have more of the contributor input into the governance at the top, including the appointments and selection of board members. If this can be opened up so that the actual contributors are actually suggesting names from a grassroots level to the highest level for them to be appointed into office to run this institution. And merit and qualification are looked at very critically. And the past experience of some of these people who are going to run those at the top. So governance is a very key one. If that is settled, I think 80% or 90% of the problems would go away.
All right.
The structure of RBA, yes, Nzomo has said right. Now we are happy that Nssf is now regulated just like all of us by RBA. But I think RBA also needs to go further as one of the contributors to policy to also regulate the civil service retirement system.
All right.
In Kenya, the system is not it's another area for challenges also.
Great, and I'm told we have Sandeep back. Sandeep, before we lost your signal there, you were sharing some thoughts regarding the streamlining of the Nssf. All right. Once again, sorry for that. We are working on the challenges we're having with the Sandeep signal just to get his thoughts regarding this. But moving on this conversation, we are also looking at a number of other proposals regarding the regulatory framework, or should I say the policy environment within which the pensions industry does operate. And coming back to Nzomo here, there is under the Tax Laws Amendment Bill, which has proposed an amendment, of course, which has moved rather an amendment regarding the RBA Act. Now, people, or rather pensioners, can access up to 40% of their accrued benefits in terms of home purchase. And one of the questions is around the implementation of this. How does the RBA ensure that this 40% is actually deployed to the intended purpose of securing a home? Is it that it will be wired directly to the bank, or how will this work, Nzomo?
Thank you. You're right. The Tax Amendment Act, which was passed recently, amended the Retirement Benefits Act and allows members to use a portion of their benefits to purchase a house. I think this is good news for members, because if you're a member of a scheme, you have some money accumulated in your scheme, you can get it to start working for you by buying a house while you're still working. By the time you retire, you know that your house is already there and you have paid for it and everything. I think it's a welcome thing from the members' perspective. So after the Act was amended, what we did as RBA is just to come up with some draft regulations. And those draft regulations are trying to balance two things. One, making sure people don't compromise the objective of the scheme or of saving for retirement, which is retirement, and therefore putting checks and balances, including what you're saying, making sure the money is actually used for the house and not used for something else. But two, allowing somebody to get a decent house. So we try to balance that in the drafts. We issue the drafts out for public comment. We received overwhelming number of comments, which we were able to summarize and try to distill all these comments. Of course, the comments themselves were also on both sides. There are those who wanted us to tighten and reduce the amount that can come out, and there are those who wanted us to give out more for the house and so on. So we tried to get a balance. So we have actually finished that process, and we have forwarded those comments together with the drafts and our proposals to the Cabinet Secretary, National Treasury and Planning for the government to consider. Okay. And if they are happy, they will gazette them, and then that is when they will come into effect. So we have built in some checks and balances to make sure that it's not abused, that it's actually used for purchase of a house, and that it can't be used for something else.
Great, and just to take up from that point, crossing over back to Sandeep. Sandeep, so sorry for the challenges we are facing with regard to your signal. Before we lost you, you were talking about the Nssf Act. We have pushed the envelope a bit, but just to pick up from where you left before we had the challenge.
Okay, Julians, I hope you can hear me now.
I get you very clear.
I'm being taken back to the analog generation. So, but anyway, so what I was saying was that one thing that people don't realize is that 70% of the assets of the Nssf are now managed by external investment managers. So that is a very big step. Of the 20% that is invested in property, all of that is also managed by external property managers. So there's been a huge shift, a huge improvement in the governance of the Nssf. But I really feel, look, we cannot keep on judging an institution by its history. And again, I don't think this is about the Nssf at all. It should be about what sort of retirement system or pension system is best for the country, and what role should Nssf play, and what role should other providers play. Now, to the point that Mr. Keeley made earlier about that if you have your own pension scheme, you should be able to fully opt out. And what I want to say is that the Nssf Act of 2013 actually provided a substantial opt-out. So most of the benefits would come through your own scheme. If you are able to set up a scheme that provides the same or better benefits, you can substantially opt out of the Nssf. So I believe there's a need for more understanding of the provisions of the Act so that we can give Kenyans this retirement security that they need. Because the point I want to make, Julians and the team, is that, look, as Kenyans, we are sleepwalking to disaster, right? The likelihood is that most Kenyans are either going to see a substantial drop in their standard of living in retirement because of insufficient savings, or for the vast informal sector, the 15 million Kenyans who make up 85% of our workforce and have near zero savings, they will be forced to live their old age over an extended period of time in poverty. And there are things and solutions that we have that we must think about implementing.
Okay.
Now, let me just give you another context that currently we are a young country and there's only 2 million Kenyans above the age of 60. But in the next 20 years, we will be more than 9 million Kenyans above the age of 60. And the cost of just providing them with a very simple basic stipend would be 334 billion shillings in today's money terms. And this is more than 50% of the government's wage bill.
Okay.
And if you add the 100 billion shillings that the government has to pay for the unfunded public service scheme every year, it's simply not going to be a viable option. We need to say to Kenyans that self-help and thrift are the only way. We need to take personal responsibility and we need to provide them with those solutions. And yes, those solutions are there. The ability to be able to open a pension account digitally is there. The ability to send and remit amounts of money, very small amounts of money, receive your benefit statement at any time, withdraw your money whenever you need to, are there.
Yes.
And as a country, we've made a huge amount of progress in terms of digital financial inclusion.
Okay.
And I think we have all the ingredients to achieve this on the pension space in the country.
Sandeep, you've raised some very pertinent issues which I'll be coming back to, especially the subject of asset allocation in the pensions industry. But let me just cross over to Jane and to the subject we were discussing before we brought Sandeep back in, the issue of the Tax Laws Amendment Act and regarding the ability to access up to 40% of your accrued benefits for home purchase. What do you think about this provision in the new regulations? Jane, if you can hear me, I'm asking you for your thoughts regarding the amendment to the RBA Act.
Yes.
Yeah, for this issue of accessing 40% of your accrued benefits for purchase of a house. What are your thoughts around this?
Julian, maybe for this one, and alluding to what Mr. Zomo has talked about, I would maybe prefer, because we have done quite a number of proposals that are at RBA for consideration, maybe I don't give the comments and probably await the consolidation of the issues.
I see, and that's a fair point you are raising. But maybe to cross over to Hosea on the same issue. Hosea, what are your thoughts regarding this provision? And of course, Mr. Nzoma Mutuku has highlighted that there are a few things which are still being worked out in terms of how this will be implemented.
Yeah, I think this is a very big step to creating the paid to attract Kenyans to pension. You know, pension is a very boring issue because it's an issue which nobody really talks about until when the time comes to retire. Pension funds also, being long-term funds, is a very good asset put together to help the government do a lot of infrastructure and other developmental needs. There ought to be more tax exemptions granted to people to encourage them to save. So by allowing the pension members or its scheme members to access in their lifetime, when they are still strong and alive, 40% of their savings to buy a home, that is actually what we consider to be a retirement benefit given already to a member in advance. And therefore will encourage more. I think the industry will grow faster that way. The second issue is that we also need to look at an additional amendment to request the government to put in place. This is to remove the element of taxation brackets being higher for those who want to save more. We find that if you want to save more than 20,000 per month, you will be taxed immediately. But when you save less than 20,000, you will be taxed zero. Now, what message are we sending to people who want to save more? We are telling them that don't save. So we are restricting the supply side of money into the pension schemes and then making people be discouraged. So we need to look at that one also to encourage more money. After all, when the money comes in, the government can borrow and actually use it for investments in the industry. Now, so what I would like to say is that opening 40% is a beginning. I am advocating for a model which is in Singapore, where you have 3 accounts in Singapore for members of the pension scheme. It's a very successful model. One portion of the money in account will go to retirement, old age retirement. The second portion will go to saving for a house. Mm-hmm. The third portion of the money will go to other things like insurance, for medical, and life insurance and so forth, and even education for your children. Now, if we approach pensions in the manner like that one, we are going to get Kenyans to take a serious interest in pension saving. For example, the RBA Act now allows schemes members to actually do what we call post-retirement medical fund arrangement. Yes. We then, if you combine the money which is supposed to be going to NHIF directly, it can come from the pension schemes so that you are able to have what you can call a pre-retirement and a post-retirement medical fund which members can enjoy when they retire. You can imagine that when you retire, Mr. Mbogo, you don't have any money when you retire for your medical fee services. Yeah. So we need to take care of all these things. And therefore, when you do that kind of bundling of benefits, you are actually creating more attraction for the public to come to pension schemes. Okay.
And crossing over to Sandeep, something that Jose has mentioned is that we need more tax exemptions. I'm just curious to know, if you look at the Tax Laws Amendment Act, one of the detail inside there is that we should remove the Nssf from the income tax exemption. How do you think this will impact the industry?
Well, I think it's very unfortunate that the finance bill has reintroduced this provision of taxing the investment income of the Nssf. It was there in the original Tax Laws Amendment Bill that was put to Parliament, and I'm really happy that the National Assembly rejected it then, and I'm hoping that they do so again. Because, look, Nssf is the largest retirement fund in the country. To tax its investment income would deal a very severe jolt to long-term savings in this country. And it's also unfair and discriminatory, because if Nssf is a provider in the industry and if its investment income is being taxed, I mean, it puts it into a very unfair state. Now, I think one reason is that the government feels that, look, this is a fund that's worth 250 billion shillings. But if you look at the 250 billion shillings, it is spread across 6 million Kenyans. And the average amount in members' accounts is only about 150 to 200,000 shillings. And to tax that would even further reduce the benefits, the inadequate benefits that are currently provided by the Nssf. So I'm really hoping that the policymakers will see sense and that this will be rejected on the floor of the House.
Thank you. And that point by Sandeep takes us to our second break. We'll be coming back with more thoughts from the panelists on that particular issue. Don't go too far. Welcome back to the Nation Leadership Forum. Tonight we are focusing on the pensions industry, and remember you can be part of this conversation at NTV Kenya, at AmbokoJH. The hashtag is NMG Leadership Forum. Before we took a break, Sandeep was expressing optimism that the proposal to tax the investment income of the Nssf will be stifled on the floor of the House and this will be thrown out. But I want to move to Jane and really just to get her thoughts, because if you talk to the parliamentarians on the ground, they will tell you already there was a proposal to tax the pension income for the senior citizens. It has been thrown out. If you look at the final finance bill being tabled, there was a discussion around deferring interest payments to pension funds. That seems to have fizzled out. They're saying already we are giving so much ground. Why can't we have this one? What are your thoughts, Jane?
Okay, maybe on the taxation about the income from Nssf fund. First of all, what amount of fund are we talking about? This is the small contributions that members make, and even the interest that the contributions earn, already it is very low in terms of what is given back. When we talk about pension, what exactly are we talking about? It is contributions plus the investment income of a time that gives you an accumulated pension. The contribution already are too low. Then we follow up by deducting taxing the investment. So at the end of the day, what are we actually then building? What are we going to accumulate? Then you even find out, if we are already struggling in terms of convincing people that saving for pension is the way. Now, when we start even making it so unattractive to save as a form of investment, are we really going anywhere? I think that thought probably was not thoroughly thought through in terms of bringing it on the table, and it would actually be able to, it would demotivate the contributors from the onset. So for me, I find it totally misplaced.
Hosea, your thoughts on this issue, and many parliamentarians for this matter will tell you these are extraordinary circumstances, and definitely we can't be dealing with the orthodoxy intervention that we normally have. Don't you think they have a case they're tabling which is fair?
Yeah, the parliamentarians would definitely have no good case to tax the investments saving of people who are in a pension schemes. You're looking at 20% of the population. How fair is it? Not only of the population, actually, 20% of the formal sector population. Taxation is meant to be an equal opportunity for every Kenyan. In other words, it's supposed to be equity about it. If you are taxing only people who have chosen to save for pension, which is not mandatory for now for employers, you are actually punishing people who have, in their own good way, decided to save for their own retirement. And yet, in the end, they say all Kenyans will be expecting their government to take care of them. Now, there are better ways of taxing some of these things. In other words, there is more money to be actually taxed if only we can bring everybody to the tax bracket, rather than exempting the informal sector the way we have done in Kenya. It is possible that if we introduce a system whereby we are able to track incomes of every Kenyan through a digital framework, technology can actually do miracles here. And we have seen it already because we have market leaders in financial sector at Fintech. We can do this in terms of taxation and actually get everybody using digital gadgets in buying and selling across the country, both in formal and informal sector. Mm-hmm. With that kind of system, all the incomes will be visible to the KRA. Yeah. And therefore, you can then reduce the weight on a few of the Kenyans who have actually tried. As I said earlier, it looks so unfortunate that we are punishing those who want to save more to pension by taxing them more because they wanted to put more. So obviously they will put their money elsewhere. So this is something which I think if we can be able to engage openly with the legislators, we will show them other ways which they can actually get the same revenue which they're looking for. Okay. And we want to remove, one of the things I have in my vision, Samboko, is that I wish we could be allowed to participate in the reforms of the pension sector and in fact the financial inclusive sector, so that we can be able to get our members of parliament leaving one of the jobs they have given themselves, which is becoming the social protector of the people. Why should the members of parliament and all the legislators take up a responsibility which is not theirs?
Okay.
Yeah. Why? Because that's the reason why they are saying we are going to use part of our salary to take care of people for funerals and for medical fees and for school fees and all those things. I can assure you, we have models outside Kenya where this happens better.
Okay.
So why are we doing it the same way with the same results?
Okay.
Surely we must be more clever than that. Thank you very much.
Absolutely. Let me cross over to Nzomo. And one of the questions which is emerging from this, Nzomo, you sit there and you wear the heart of the regulator, is that we've seen a raft of interesting proposals in the recent past regarding the pensions industry, whether it was the proposal to tax pension income for senior citizens, which of course has been shelved. Now we are looking at taxing the investment income of Nssf. And many are asking, where is the regulator's voice when all this is being considered?
Yes, of course. As a regulator, we have all along been urging for more tax incentives for pensions. We always submit memorandums every year to the government, trying to get more tax incentives for saving for retirement. Out of all the various forms of saving that you can do, saving for retirement is the most noble, and it's the one which should be facilitated through tax incentives. So for many years, and we have been successful, we must say that we have been able to get a number of these incentives passed over the years, and we continue to lobby for more. So certainly we were quite happy to see that those proposals that were there initially with regard taxing those over 65 and also the investment income and Nssf were not passed. So we are happy with that.
All right, and crossing over to Sandeep. Sandeep, you've got a number of issues you'd like to offload even as you chime in into some of these issues being raised at this point.
I can't hear him either.
We seem to be having a challenge with Sandeep's reception on that point. Just coming back to Hosea, there is the issue of asset allocation as far as the pensions industry is concerned, and many have expressed concern that there isn't much diversification. Hosea, what are your thoughts regarding the asset allocation in the industry?
Yeah, I think we could do with some bit of improvement. I want to say that our regulator has really tried by providing the opportunities we have. We do have a lot of assets, opportunities in fixed income like treasury bonds and treasury bills. I know we can do 100%. We could reduce a little bit of that so that the government doesn't overborrow from the pension industry and leave some of it to be taken by other sectors of the economy. For example, the private sector, we need to create a vehicle for actually providing funding to SMEs in a vehicle which provides protection to the savings of the members in the pension industry, while at the same time availing long-term funds through possibly the banks without having arbitrage. Without having arbitrage the whole thing, then the banks can on-lend the money to the SMEs and enable the private sector, the farmers, and the cottage industries to grow. At the moment, there's hardly much going there because we are a challenge with the corporate bonds, which are normally issued by the big industries, but there's no corporate bond being issued by the agricultural industries. We really need, that is the future growth where we need to really focus some of the funding for industry. For example, we want to encourage forestry as a way of dealing with environmental protection. In other countries, South Africa and others, they have actually forestry is an investment of pension funds. Why can't we do the same in Kenya? By creating frameworks for pension industry to invest in long-term assets like those ones, which have a valuable contribution to the environment.
Okay.
There is no funds coming from, there's no money going from the pension industry to provision of water, which wananchi require all over the country. Mm-hmm. Why can't we create an instrument to enable us lend money to our water sector? Why can't we create a vehicle? And this is possible when CMA and the other, and Central Bank and others come and think around outside the box and give instruments which have been given in other countries to be able to deal with real problems of Kenyans.
Okay.
So as far as that is lacking, I can say we need a bit of reforms in the asset allocation of our available funds.
All right. And Sandeep, if you can hear me, we are discussing the subject of asset allocation. I do know that definitely you have a number of issues you'd like to raise. Just share some thoughts with us.
Okay, so Julians, I've missed most of the last 15.
Continue, Sandeep. I can hear you.
So I'm not quite sure, therefore, whether, that'd be... I'm getting an echo.
All right.
Julian?
I can hear you, Sandeep. I can hear you.
Seem to be having a challenge.
All right, maybe we cross over to Jane. Jane, the subject of asset allocation is emerging. Of course, Jose has raised a couple of issues. Are you worried about concentration risk in terms of asset allocation?
Julian, I don't think this...
Yes, Julian, I think I am also equally worried about the asset allocation. I think we have we look like we have saturated in terms of even the choices we are making for the assets for investment. I think it's high time now we get an open up to other options so that we can be able to diversify.
Coming back to the regulator, that is Mr. Nzomo, the issue of asset allocation is, of course, standing out here. We know that RBI has been putting in some efforts. Perhaps just enlighten us on what more is being done to put out more investable opportunities for the pension funds.
It was done by Alliance, and they ranked the pension sectors in Africa. And you'll be happy to hear that Kenya was ranked number 2 in Africa after South Africa. And if you look at our country, the size of the economy or development or population, we are not number 2. But when it comes to pension sector, we are number 2. And why are we number 2? Because we have put in place a lot of very solid structures to ensure stability of the sector. And one of the areas we have done quite well is the area of investments and the asset allocation. Again, I'm looking at the figures which are scrolling down there. If you look at those figures, those percentages, and you compare with global averages, we have actually done very well. Because in many countries, you find something like 70% of assets is in government securities. But here you can see the figure you have down there is 39%. You also find we have 17% in equities. Again, in many countries, you don't have that level of investment in the capital markets. We have very progressive investment guidelines in Kenya, which allows a wide range of investments. But I think, as Jose has pointed out, on the supply side, some of those investments are not there. You'd want to invest in certain debt instruments, for example, for infrastructure, but we don't get them in the supply side, and that kind of constraints the market. But I think in terms of the guidelines we have on the framework, it's actually very, very progressive, and our investment portfolio is quite well diversified.
Right, and indeed we've seen a couple of reforms, including raising some of the minimums which can be invested in areas like private equity. But just to stay with you, Nzomo, the issue of post-retirement medical fund guidelines, we saw this being published in October 2019. How is it impacting the market thus far?
Yes, that's another innovation which we introduced in the market. The idea was that, when we did surveys and we went out and talked to people who have retired, and they have even taken their pension and so on, they told us the biggest challenge they're having is medical, because medical expenses can be very high, at an older age. To make matters worse, some of them told us that even if they have the money, they would go to medical providers and be told, we are not going to cover you because of your age. So they had a lot of challenges in medical. So we thought perhaps the way to solve this is for one to start saving for medical while still working, so that when you retire, you already have a package of money which you can use to get medical cover. So the act was amended, the regulations were done, and finally the guidelines were issued last year, and it has kicked off, and a number of employers have put it in. Now, the way it works is, you save on top of what you're saving for retirement, you also save for your post-retirement medical. It is the Singapore model that Hosea was talking about. So you have an account for your pension and you have another account for medical. So it's new, it's just kicked off, but we know it's going to help a lot of Kenyans when they reach retirement, and they'll have this package that they can use for medical.
Hosea, just to quickly get your thoughts regarding the post-retirement medical fund and how you think this is impacting the industry. We saw the guidelines being published in October last year. What's your sense around the uptake?
Yeah, the industry has taken the post-retirement medical fund positively. The only thing which we would need to do is actually to engage, sensitize employers to be able to deduct this money from members as an additional contribution to the pension scheme, and then the pension scheme can put the money aside for the members for their retirement medical support. There is also need to have very proactive insurance companies which can then underwrite part of the medical cost within the fund arrangement to make the whole thing work. Now, this model is, we are still working with our professional advisors and particularly the actuaries, so that we are able to have a sustainable post-retirement medical fund. In our schemes, county pension fund, we are hopefully going to be able to roll out such a fund in due course because we have been working on it. But what is a challenge is for the pensioners. The pensioners have not had a chance to save for this post-retirement medical fund, and possibly we will have to consider a way in which there could be an element of taking a lump sum from part of their pension to fund that post-retirement medical fund, because it would be unfair that the fund would only be available to those who are still in employment, and for those who have retired, they have nothing. So we are trying to find a model which will work for them also. Okay. So that is what our views are here.
All right. Jane, if you can hear me, your thoughts around the post-retirement medical fund. Of course, Hosea is proposing some modifications which he feels could enhance this provision.
Thank you, Julian. I think I also have maybe my thoughts about this area and this latest policy and guidelines. First, I need to acknowledge that is the best decision that has come for the benefit of the retirees, because if you look in their basket in terms of the costs from their pension, a lot of it goes to taking care of their medical needs. And maybe taking a back, we also need to understand the kind of client that we are talking about. This is the retiree, or maybe in other terms, who we call the older persons. What are their health conditions? They are actually the non-communicable diseases, or NCDs, is so inherent in their lives, such that when an older person is having those conditions which exist, you know, there are comorbidities or multimorbidities that is existing at the same time. If you are to look at the condition independently and cost for it, it would be very, very expensive. And you see the conditions also progresses with time. Yeah. So my thought about this is that the policy is good, the thoughts are very good, but it is not yet in terms of, we cannot talk about it as being very complete in terms of implementation. Why am I saying that? As Hosea has said about the insurance and underwriting, remember this is an area that maybe in insurance, we can call it a high-risk area. Yes. So at the end of the day, it can be very, very expensive. Okay. So what is the way forward? Because we cannot just be left there. My thoughts have been that this is one of the areas that is really calling for collaboration among partners. That is as provided for in the Sustainable Development Goal number 17, okay, whereby we come together as the regulators and the ministry. Yes. Who are the regulators that I'm referring to? We are talking about the retirement benefits sector, yes, whose main role is to mobilize funds, and that is why they have come up with the provision of that fund and the policy. Then there is the insurance industry. as the risk taker or the underwriters. But we also need to think about how are the insurance industry going to be able to deliver on that risk.
As we wrap up,
there is also the need of the Ministry of Health coming into place so that we see a collaboration between the ministry, and this will go a long way in terms of providing for that. For our information is that this older person we are talking about, their health care needs are specialized. They just do not need the existing framework because it is already very segmented in terms of handling their multiple conditions.
Jen,
so we need a specialist or a specialization in this area so that when another person presents themselves to a provider, all their issues are handled at that point. And that way it reduces on the cost of treatment. It also needs to extend to a point where we are not only thinking about the hospitals, we are also thinking about home care, because that would be able to reduce the cost of managing the conditions. And also maybe a lot of training and capacity building about disease management.
I have to hold it there with you.
So for this to be successful and for us to be able to pick off, I think it's high time we have collaboration discussions among the two regulators and the Ministry of Health. And this needs to take
we shall
immediate
hold it at that
effect
point, and
because already we have like close to 29%.
We need to be wrapping up just to get our closing thoughts around this.
If you go by the Kenya National Bureau of Statistics Census
the Retirement
last
Benefits
year.
Authority CEO Nzomo Mutuku, what are your closing thoughts as we wrap up this show?
Thank you very much, Julius, and thank you very much, viewers. I want to urge Kenyans to take up the opportunity of saving for retirement. We have a very good system. Like I've said, it's ranked #2 in Africa. It is very secure. We have independent fund managers. We have custodians who keep your money safe. We have a very strong regulatory framework which makes sure that you're safe. And if you have any challenges, you have a regulator that is RBA. You can come to us and we can assist. You. If you save for retirement, when shocks come, for example, we have the COVID shock. We saw some people being retrenched. Those who are retrenched were able to go to their pension scheme and get some money out, which helped them in this shock. But those who are not in pension schemes, they didn't have that cushion. We've talked about housing. You can use the pension scheme for housing, so you can save through the scheme and get a house. We've talked about post-retirement medical that you can get through your scheme. So we have all these very good products, and we really urge Kenyans to take up and save for their retirement so they can have a better life in retirement. Thank you.
All right, many thanks, Nzomo Mutuku. And unfortunately, we are out of time, and that takes us to the close of our discussion on the pensions industry on the Nation Leadership Forum. Thank you so much for giving us your thoughts on the social media handle. Thank you so much to our panelists. We have really appreciated your thoughts, and apologies if we lost Sandeep just midway the conversation. We definitely will be seeing how to get his thoughts regarding this subject. That takes us to the close of Nation Leadership Forum. Don't go too far. The news is up next with Ken Mijungo.